What credit score is needed for a mortgage? Are you ready to buy a house, but you have no idea what kind of credit score you need, what type of credit, what your credit should say, how it should look? Well, you are confused, and I was too. I'm gonna tell you exactly what you need to know about your credit and mortgages so you are no longer confused. Let's go.
Noel. Yeah, she can fix that. If you gotta get it done, or you need to do it better, well, she can fix that. Yeah, she can fix that. Investment to get back, trying to get a big stack. She can fix that. Let's fix that.
I'm gonna tell you the biggest secret that I learned from over 18 years in the mortgage business. I'm gonna share with you 3 hidden ways that you can get approved for a higher loan amount. And I'm gonna share with you the biggest mistake that people make that gets them declined every single day. I'm gonna share it with you so you don't make that mistake. So let's first talk about how the mortgage loan process works. As you may know, the mortgage process can be very daunting for many people. It starts out with a very, very long application. Let me tell you about it. The application in the business, we call it a 1003, which is 1003. That's the code for the Fannie Mae form. And it's about 4 to 5 pages. On the mortgage loan application, it's going to break down everything. It's going to break down not only the type of home that you're buying, the year, the interest rate, the loan terms, and things like that. It's going to break down all of your information, your name, your social security number, your birth date, your employment for the past 2 years, all of your assets. You're going to have to list out every single one of your assets, all of your bank accounts, all of your savings accounts, all of your retirement accounts, and what the balances are. Additionally, you're going to have to put every single one of your debts. All of your debts that are listed on your credit report will be uploaded and added to the 1003, and then they're going to go through a whole process where you will sign it, and then that is the application. Additionally, with a traditional mortgage, they are going to look at your employment and your income. Typically, they're going to look for the past 2 years of employment to see that you have stable employment that has continued with no gaps longer than 30 days. Additionally, from your employment, what is your income? How often are you paid? What is your annual salary, monthly salary, things like that? All of those things are going to put together your entire mortgage profile. They're going to take your application, they're going to determine what your debt ratio is, meaning how much debt do you have in ratio to your income. Like I said, they're going to dig into your employment and your income, and they're going to calculate how much money you make per month on a gross basis. Then they are going to divide that number. For example, if you make $24,000 a year, we're just going to use gross numbers, that breaks down to $2,000 per month. Then they're going to look at your credit report and list out all of the debts that are there, all of your credit cards, all of your auto loans and things of that nature. And then they're going to add those numbers together. There's going to be 2 different debt ratios. One debt ratio that includes the new mortgage that you're trying to get, and that's going to be like the qualifying amount that you can get. And then they're going to give you a debt ratio without the mortgage. Okay, so that's your back end ratio and your front end ratio. Don't necessarily get too caught up in those things, but I'm just explaining the process so that you know exactly what mortgage lenders are looking for. Now let me give you some hidden tips on what they're really looking for and how to present this information correctly. So the next big thing when it comes to getting a mortgage that I didn't mention before, of course, is your credit report and your credit scores. Because of course you're wanting to know, what credit score do I need? So let's break that down. As I stated before, they're going to pull your entire credit report. In mortgages, they actually pull a different credit report than they do for auto loans and credit cards. It's called a mortgage residential report, all right? And it will have your FICO score. It will be a tri-merge. It will be all 3 of the credit bureaus in one report. It will be the Equifax report, the Experian report, and the TransUnion report, all in one credit report, okay? Additionally, they're going to have a score. All 3 of those bureaus will give you a score. For example, for a mortgage, in most cases, you're going to need at least a 640 credit score. Now, that's just traditional. I'll get to some hidden ways in a second. But on a traditional mortgage, the lowest credit score they're really going to want is a 640. And that is going to be determined by your middle score. Like I said previously, you're going to have a credit report with 3 bureaus. So they will have 3 different scores. You get a score for your Equifax, your TransUnion, and your Experian. Usually they are very similar. For example, you may have a 640, a 645, and a 650, between the 3 credit bureaus, and they will take your middle score to qualify you, okay? But more importantly, are going to be the trade lines on your credit report, how well you've paid them. So not just the credit score matters, but also how well you've paid your other debts, okay? So for example, you have this great credit score, you have a 720 credit score, you look on Credit Karma, and you're like, wow, I got a great credit score, but you only have one Capital One card. You're probably not going to get qualified for a mortgage because it's not just about the credit score. Let me break that down for you. So when it comes to getting a mortgage, there are 3 types of traditional mortgages, okay? You have conventional loans. Those are your Fannie Mae and your Freddie Mac backed loans. Those are the traditional mortgages that most people get when they go to a bank. If you went to any bank or any credit union, most likely, if you have decent credit, they're going to offer you a conventional mortgage. You will have to put down 3% or 5% or 10%, or if you're buying a second home or an investment property, you're going to have to put down more. So let me give you a quick example. You have 3 different types. Like I said, you have Fannie Mae and Freddie conventional loans, and then you also have government loans. That's the second type of loan. So think FHA loans, VA loans, USDA loans. Again, these are similar loans that you will go to a bank or a credit union to get. However, they are backed, meaning they are securitized by the government. The Federal Housing Authority guarantees those loans. Now, there's not anything that you need to do with that information. Like I said, if you're applying for a mortgage, you're going to go to Bank of America, Chase, or your mortgage banker, or wherever you go to, and you don't necessarily need to know this, but I'm telling this to you for your own information because it is important. You're going to ask what type of loan you're getting. Am I getting a conventional loan or am I getting a government loan? And then there's a third type of loan. That is a non-government, non-conventional loan. It's called non-QM, which stands for non-qualified mortgage. It used to be called subprime, okay? And so I know many of you have heard the term subprime before, in 2008, 2009, too many people were getting these subprime mortgages, meaning you could have bad credit, you could have low income, you didn't have to verify your assets or your income or your job and things like that. They really took the guidelines down and more people were able to get mortgages. Unfortunately, many people were not able to afford those mortgages, were given mortgages. So subprime got a really bad name. And rightfully so, because in many cases it wasn't explained to people. However, those loans are back, and this is a big opportunity for you if you know and understand how to get one of those loans and how to use it properly so that you don't end up in a bad situation. A non-QM loan can be perfect for someone that is self-employed or someone that has a job that they just started, or they're a contractor, meaning they make a lot of money but their tax returns may not reflect it, things of that nature. So you can have a much lower credit score. In fact, with a non-QM loan, you can have credit scores as low as 550. All right, I'm going to put a link below to a lender that I know that goes down to 550 on a mortgage through a non-QM product. You can do different things like bank statements to show your income. You can do verifications of employment. I'll explain that in a second. So the basic thing that you need to know is that there are 3 types of loans: conventional, government, and then non-QM loans, and different credit scores will apply. With your conventional loans, you're going to need a 680 and above. With your government loans, you're going to need like a 620 to a 640, and then with your non-QM loans, you can really go down to 550. You're just probably going to need a higher down payment. Let me get into that really quick for you. Okay, so another very big thing that you need to know when it comes to credit score, like I said, it's not just the credit score that matters. You're going to need a credit report that reflects that you've had different types of accounts and that you've paid them well. So like I said, just because you have a 720 credit score, if you only have one Capital One card, you're probably not going to qualify. In most cases, they're going to want you to have at least 3 trade lines, and they're going to want you to have at least one of those trade lines be at least 24 months old, meaning you got that credit at least 2 years ago. Again, what lenders and banks are looking for is your ability to repay the loan more than anything. They're in the business of loaning money for mortgages. The great thing about mortgages and why they're not as difficult as people think is because they are collateralized loans, meaning you have a house that's working as collateral to the loan. So banks are a little bit more loose with lending to people on a mortgage than some unsecured types of debt. credit cards and things of that nature. So if you have had a situation where you have credit that's more than 2 years and you have a couple of trade lines, you have stable employment, you've worked your job for maybe 2 years, most likely you will be able to get a mortgage of some type. Let me give you a quick hint. If you have a situation where you think you may have some tricky credit or you don't have some of the credit scores that I mentioned, I strongly suggest finding a mortgage broker. Okay, there's a big difference between going to a bank for a mortgage or a credit union and going to a mortgage broker. Mortgage brokers are not banks. They are literally brokers, meaning they are tied to multiple lenders. So they may be able to look at your credit, pull it one time, see your situation, see what your credit is, and then send your loan or your application to the best fit. Okay, so that's increasing your chances of being approved. Instead of going to different lenders and seeing if you're approved, you can go to one mortgage broker and they can help you out. So it really depends on your situation. Hopefully that answered everything and you completely get that if you have a situation where you're not quite sure, you might want to reach out to a mortgage broker. So I have a couple more points, but I noticed you haven't subscribed yet. So this will be a great time for you to go ahead and click that subscribe button and make sure you click that notification bell so you don't miss any of this content. Okay, so let's get back into it. So another thing that you can do that is super important is you can skip all of this. I know this sounds crazy, but literally one of the things that I do is I don't really deal with banks and mortgages anymore, okay? I work as a real estate investor, meaning I find people that are having property problems and I'm able to get and acquire those properties for pennies on the dollar. In many cases, those people already have a mortgage and they're having trouble paying that mortgage, and I'm able to take that property and take over that mortgage payment without ever having to deal with any banks. It's a concept called subject to. Again, I made an entire video on subject to teaching you all about how to do this, how to start thinking like a real estate investor, and how to get properties without having to deal with banks or your credit. I'll put a link to it and you can watch that whole video. So you can skip this whole thing and just go right to getting properties. So there you have it. You know exactly what credit score is needed for a mortgage. If you are looking for more information and you are loving all of this content, I have created an entire program, an entire training just for you, absolutely free. Please check out noelsfreetraining.com. Again, it's a training that I made. It's about an hour long. It was a little bit too long to put up here for you, but it will teach you my exact formula for investing without losing money so you can get started. Again, Noel's Free Training. Make sure you check it out and we'll see you in the next episode. To your success.